A brutal day on Wall Street. Stocks plunging as the yield curve inverted for the first time since 2007. The selling widespread. The Dow dropping more than 800 points. All 11 S&P 500 sectors finishing the day in red. The market meltdown leaving many investors on edge and sparking fears that a recession could be on its way. So what's your take on the day? Guy Adami.
Well, my take on the day is it makes a lot of sense. I mean, volatility is here. I think volatility will continue to grind higher. Pete can speak to this. When is it over? I mean, that's what everybody wants to know, so I can pontificate. But what should be looking for? In my opinion, I think you're looking for a VIX that climbs near 30. We've seen it sort of peak out at those levels before when the market basically troughs. Or you're looking for the S&P 500 to put in a low about 2690 or so, which if you do the math is midway between the low we saw on December 24th and the recent high in the S&P 500 of 3025. Carter will be on. I'm sure he'll speak to levels, but those are the things you're looking for. In terms of does it make sense? I think it makes a lot of sense, and I'll say this as well. The gold market has been telling you something like this been in store for the last few months, Mel.
The data around the world, negative yields around the world have also been telling you the same story, Tim, and we really got a dose of very bad data that started us off on the wrong foot.
Look, the data continues to get worse, and Guy starts talking about what he needs to see different. Unfortunately, I think we're in a case where the data really, while the leading indicators 12 to 15 months ago already started to give way, it's hard to say that the data is anywhere close to troughing, especially when we haven't really even begun to solve some of these trade disputes or trade sanctions or trade restrictions, which continue to be the dynamic. Again, you've got industrial production tonight in Japan. You're going to be watching that. Tomorrow morning, we have retail sales in the United States. We have an Empire State survey, a lot of regional Fed surveys. Remember, we've seen some multi-year lows. We've seen 10-year lows on a lot of the Asian PMIs, Hong Kong, obviously with the extreme case. But again, yesterday you saw German confidence indicators at 2011 area. And that to me is a market where we didn't have any confidence. So I need to see data change. And you're right. It's the data that really led us lower.
Yeah, and then you pile on top of that what Secretary Ross told Squawk Box this morning, effectively that the September trade talks that we all thought were happening with the Chinese coming to Washington, D.C., nothing has been formalized yet. So if we thought that was a catalyst, we don't even know if that is going to happen at this point.
You know, so yesterday's rally we had was on the Trump news with China, maybe progress there. I was surprised at how strong that rally was, because how many times are they going to play this, oh, there'll be a deal, there'll be a deal, there'll be a deal. I mean, this has been now, we're coming up to a year when they first started tariffs. So maybe they will start talking, maybe they won't. I don't think we can rely on it. To me, though, I mean, there was a lot to hate about today. It didn't seem that ultra panicky, though, till the end, right? It sort of really did start to sell off at the end. I don't know what to make of it all, except, you know, the market's down 2.6% for the week. It's not that much off its all-time highs. Yet this action between Monday, yesterday, and today, the net of that being down 2.6, it's much worse than that, right? Because CEOs, they get uncomfortable, as investors get uncomfortable.
Consumers get uncomfortable.
Consumers get uncomfortable looking at this kind of volatility. So that's not great. You don't want to have a sort of self-fulfilling prophecy of fear begetting contraction. I don't know what to do here, actually. I'm not a buyer. Normally, you know, I always say things trade down in integers. I like to be out there. I have a list. I wasn't close to buying anything today. I'm going to wait. Yes.
Yeah. A lot of people make the argument, Pete, that most Americans are not in the stock market, so they won't feel this pain. But they see a headline in tomorrow's newspaper or online right now, Dow down 800 points.
They're going to call their broker. They're going to call wherever their money is. And obviously, we know that the Chinese economy is slowing down from significant levels from where it had been so powerful to where it is now. And then you hear the German news. I mean, the more people understand about the market and the more they look into it and read these headlines, Mel, the more scared they're obviously going to get. And I think we already know this algorithmic trading, it moved to the upside on Tuesday when we went up 400 points, just like when we went down 400 points on Monday. Today, same type of thing. Some of those moves were so fast, that is not human. That is algorithms that are hitting, and they are definitely flowing to the downside. And there's all the headlines in the world that you could use right now to trigger some of these moves to the downside. You mentioned volatility. Just last week, or actually on Monday, we had huge buying of the January 30 strike calls in the VIX. Now, they were right last time when they were buying huge amounts of volatility index calls, and now are they going to be right again? Will it? By the way, doesn't mean it has to go to 30. It just means that they are seeing upside, and those volatility options could move very, very rapidly, Mel, to the upside. Right. If we get up towards 26, 27, they're moving. It doesn't have to go through 30, and that's what people forget so much of the time. Well, they bought the 30s, it's got to go to 30. No, it doesn't. They're just buying something that they valued, and they said, you know what, we're going to own this because we think this is going to happen. So when you look at all of this right now, I think there's a lot of different things. We were seeing put buyers today, more so than I've seen in a very long time. And I talked about it earlier in the day, but I'll bring it up again. The EEM, 62,000 puts were rolled from August into September, and they went down from 40.5 to the 37.5. They are expecting the EEM, which is led by China, to go a lot lower than it is even today. They're expecting even more to the downside.
Right. So all day long, we've been talking about the source of the selling, and it was the inversion of the yield curve. And there's a huge debate as to whether or not this indicates if we're going to be in a recession or not. Does it matter at this point if that is the indicator for a recession?
We're always looking for reasons to identify why things happen. I understand. You want to be able to label it happened for these reasons. I totally get it. And obviously today specifically, those headlines mattered. But go back, and I'll say it again, go back and look at the way Facebook reversed after they reported earnings. That was a $215 or so stock. Look where it is now. Same thing happened with Amazon. And effectively, although not entirely the same level, Apple's done a very similar move to the downside. My point is, they're big, huge stocks that sort of led this. Now, we'll talk about the inverted yield curve. Yes, obviously it's not a great thing. The bulls will say it's different this time. I'm not certain that that's the case. But quickly, in terms of what Pete was saying about consumer confidence, you just said it. We're going to have a special tonight. The evening news will lead with Dow down 800. People see that for a day, a couple days. They say maybe we shouldn't be getting that Starbucks. And when 73% of your economy is driven by the consumer and the consumer flinches, that's when you have real problems.
I think the bears could argue that this inversion is even worse this
Yeah,
time
so
around.
I don't know which camp I want to be put in. I will just speak for the Bears right now and say that's exactly right. So first of all, 3s, 10s, 3-month out to 10s has been inverted since May. So to be clear, that tells you a market that really thinks the Fed, to oversimplify this, the Fed is really offsides because the Fed is controlling the short end of the curve at this point. If you think about what a lot of very talented strategists have come on our show to tell you is that when you have an inverted yield curve, you have anywhere from 12 to 18 months where equities can actually start.
Can we show that graphic, actually? We've got the data.
We should do that.
The data behind it.
We should do that.
Right.
So the bottom line for that is in a normalized yield curve environment, which there is no such thing as a normalized yield curve environment, you have some period where equities can actually continue to outperform until the teeth of the recession kick in. The bottom line is that was never going on with 10-year bunds at minus 65 basis points. That was never going on where you had 16 trillion of negative yielding bonds around the world. You have a dynamic here which we have never seen. And I get back to what I say. The market is behaving, the bond market is behaving as if we have black swan risk, that we have 3 standard deviation risk. And the moves in the bond market have been 3 standard deviation moves. And you don't just get those moves and they don't just go away quietly.
And it wasn't happening either when the Fed had so few bullets left to use if there was an actual recession on the horizon.
Yeah, I mean, it is amazing. And what is the next step to the Fed? And are they putting themselves into, or have they been put into a corner by the president, who is continually just coming after them and after them and after them? Mel, I'll just bring up one last thing. This gold run that we've seen, it has been going on for a while. It's not. I see a lot of gold bulls suddenly coming in saying, hey, I think it's time to buy gold. By the way, this started in May. I mean, the GLD was 120, now it's 143. 52-week highs now. GDX, 52-week highs again today. SLV, 52-week highs today. So there's been some running that's already happened into this. So I just want people to understand that, hey, look, are you buying a top? I'm not saying it's the top, but I am saying this has been something that's been going on now for at least a month, in some cases 2 or 3 months, Mel. And to keep an eye, you have to be disciplined. I took off all my GDX today because I've been overexposed in these metals. And I don't want to have too much exposure there because at any moment, if we get any kind of positive news in the market, I think we'll start to see the GLD and the GDX and the SLV, all of that start to pull back if we see a big positive.